the oldest varieties of life insurance, term and whole life, remain among the most popular types. Whole life is a form of permanent life insurance that lasts your whole life. It also accumulates cash value that you can withdraw or borrow against while you're alive. Term insurance, on the other hand, lasts only for a certain number of years. The term and does not accrue any cash value. In addition to whole and term life, several other variations have arisen, such as universal life. Today, the best insurance companies offer more complicated products to reach a broader range of customers. But getting back to basics, what's the difference between term and whole life? And which one is better for your needs? These two types of policy remain the most popular and easiest to understand. We'll break down the key features that distinguish these insurance mainstays. Term life insurance is perhaps the easiest to understand because it's straightforward insurance, without the bells and whistles. The only reason to buy a term policy is because of the promise of a death benefit for your beneficiary should you pass away while it's in force. As the name suggests, this stripped-down form of insurance is only good for a certain period of time, whether it's 5 years, 20 years, or 30 years. After that, the policy simply expires. 1. Because of these two attributes, simplicity and finite duration, term policies also tend to be the cheapest, often by a wide margin. If all you seek from a life insurance policy is the ability to protect your family when you die, then term insurance is likely the best fit if you can afford it. Since term policies are typically more affordable and can last until your child enters adulthood, they could be an option for single parents who may want an additional safety net. A variety of factors will change those prices, of course. For example, a larger death benefit or longer length of coverage will certainly increase the premiums. Also, most policies require a medical exam, so any health complications could raise your rates above the norm as well. Because term insurance eventually expires, you can find yourself having spent all that money for no purpose other than peace of mind. Also, you can't use your investment in term insurance to build wealth or save on taxes. Whole life is a form of permanent life insurance, which differs from term insurance in two key ways. For one, it never expires as long as you keep making your premium payments. It also provides some cash value in addition to the death benefit, which can be a source of funds for future needs. Most whole life policies are level premium, meaning that you pay the same monthly rate for the duration of the policy. Those premiums are split in two ways. One part of your payment goes to the insurance component, while the other part helps build your cash value, which grows over time. Many providers offer a guaranteed interest rate, often 1% to 2% annually, although some companies sell participating policies, which pay and guaranteed dividends that can increase your total return. Early on, the amount of the whole life premium is higher than the cost of the insurance itself. As you get older, though, that reverses, and the cost becomes less than that of a typical term policy for someone of your age. This is known as front-loading your policy. 5. Unfortunately, the death benefit and cash value aren't completely separate features. If you take a loan from your policy, your death benefit will go down by a corresponding amount if you don't pay it back. If you take out a $50,000 loan, for instance, your beneficiaries will get $50,000 less, plus any interest due, if the loan is still outstanding. The main disadvantage of whole life insurance is that it's more expensive than a term policy by quite a bit. Permanent policies cost on average between 5 and 15 times more than term coverage with the same death benefit. For a lot of consumers, the relatively high cost makes it hard to keep up with payments. So which type of coverage is best for your family? If term coverage is all you can afford, the answer is simple: basic protection is better than no protection at all. The question is a little trickier for folks who can afford the substantially higher premiums that come with a whole life policy. If your goal is to save for retirement, many fee-based, that is, non-commission earning financial advisors recommend turning to 401(k)s and individual retirement accounts, IRA first. This is the age-old question in the life insurance business. The answer is that it depends on your needs and wants. If you only need life insurance for a relatively short period of time, term may be better as the premiums are more affordable. If you need permanent coverage that lasts your entire life, whole life is likely preferred. Whole life also offers several living benefits deriving from its cash value accumulation, which reduces its actual cost over time. Life insurers or their agents receive a commission from selling a policy. This usually amounts to between 60% and 100% of the first year's premium amount, in a series of smaller ongoing residual payments each year. Typical term life policies come in terms of 10, 15, 20, 25, or 30 years. A small number of insurers will offer 35 and 40-year policies as well. Whole life insurance certainly offers more financial flexibility with its cash value component. Nevertheless, because permanent policies are more complex and expensive, a lot of consumers follow the old axiom: buy term and invest the rest. We are going to end this video right away. If you have any query or information to share, please leave a comment below. Thanks for watching.